Okay, so in the next few moments, I'm going to cover a few things. So these are the things I'm going to cover. What is ETF? The benefit of ETF, where to find the best ETF to invest, and then how do you actually construct an ETF portfolio, and what are the potential returns, by using different ETF, to create the portfolio itself. So this is a tree diagram of STI component stocks. And STI component stocks consist of 30 stocks. We call it the 30 blue chip stocks. When we put all the 30 stocks into one basket, all right, and form what we call the STI index or STI index ETF, then this ETF itself will basically consist of these 30 stocks. Now, it is good for people who actually wants to participate in the Singapore economy, and you don't want to go through the hustle of picking and choosing which stock to invest. So what you do is that you go up there and buy a basket of it. And the reason of doing so is because you can save a lot of time and you can do passive investing by using this method, right? Especially you do not require you to spend a lot of time trying to look into each companies. So ETF is actually more than that, right? Having saved time, having to do passive investing is only a small part of it. But itself, ETF can do much more, okay? So the number one benefit of ETF is that it can do diversifications. And that will means that you can actually expand the ETF investment into various things, whether you are investing by countries or whether you want to invest by sectors, in other words, the different industrial, or you want to invest in different asset class, whether is it going to be equity, going to be REITs, or going to be commodities, or going to be bonds. All these can be ETF in the basket, right? And by doing that, basically what an investor do is that there is a saving of a cost, right? So it is very cost effective. Imagine if you go up there and if you start to buy different asset class individually, say for example, you want to buy a Singapore government bond, or you want to buy a DBS bond, SIA bond, or gold, or even let's say certain REITs. By investing individually and put a portfolio itself takes time and is very expensive because every transaction will incur a brokerage charge. Whereas in ETF, when you buy in a basket, it's basically one price for all. So it's very, very cost effective. The third one is it easily to access into different market sectors. And this is exactly what I was trying to say. If, let's say, supposing if you are finding Vietnam is a growth market, you can actually go up there and buy a Vietnam ETF, right? Instead of just trying to figure out, what companies to buy or invest in Vietnam. And tendency is going to be too difficult because that will also means, changing your currency into a local currencies, so on and so forth. So it's pretty complex. The fourth is it is very transparent. Now, some people will ask, well, what's the difference between an ETF and a unit trust? Well, basically both are almost the same because these are all equities or different asset class put in one basket, and they are all managed by professional fund manager. So both have very little differences. But the major difference is that ETF is very, very transparent. When you go up there and buy ETF, the price of ETF is actually on your brokerage platform. Whereas unit trust, You can only browse it through, let's say, Bloomberg or Morningstars, and it will give you the price. But by the time when you want to buy or sell your unit trust, you will still have to go through your banks or your agent to do so. And the bank or agent will only give you an indicative price, not the real transaction price. The real transaction price will only comes in a day or two later in order to get the price, right? So there's always a delay in terms of doing transactions on unit trust itself. Whereas ETF is very transparent. And in fact, a lot of ETF, there are so many informations in them, you can actually look into the ETF holdings itself. And then the last one is basically flexibility, which is you can buy and sell anytime you want, as long as it is within the trading hours. You can buy and sell any of the ETF, access any market, any sector, within that trading hours. And the money that that you can invest or withdraw is almost, quick, right? It's like 1 or 2 days, you can get your money, come back to your own account. So these are basically the 4-5 main benefit of using ETF to construct a portfolio. Now, I will just go into the most important thing is to assess the different market and sectors. So when we are able to assess a different market or sectors, that will also means that we are allowed, to pick and choose a lot of what we call the niche market or growth market that we wish to invest. So for example, in ETF, we divided them into transportations and automobiles. Like, for example, you like to invest in EV companies, electric vehicle companies, you can actually go out there and buy electric vehicle ETF these days. Or if you are interested in the banking sectors, like in the past, you hear people, buying into US Goldman Sachs, JP Morgan's, or even some of the rating house like Standard & Poor's and things like that. You can actually go up there and buy ETF that contains all these companies. Not to mention that there are some companies like insurance or retails or in IT sectors. And all these is what we call team investing. If you feel that a particular sectors that will grow rapidly or will give you the highest return. So instead of just go up there and pick a company to invest, you can just buy a basket of it and you let that sector grow, right? So for example, over the last, I can say, since April last year, the fastest growth area in the stock market, global stock market, is actually the technologies. So if you would have invest in technology sectors from April last year, the gain itself is already more than 150 to 200% in some cases. So picking the sector to invest is not really difficult, which I'm going to show you how we can do it in a moment, right? So I'm going to ask a very, to illustrate what I'm going to tell you, I'm going to ask a very, very specific questions. Now you read headline like this. China tech companies are going global and they are remaking China image in the process. Now, when you read headline like this and you are exposing with all the news and things like that, how many of y'all think that China technology will continue to grow in the next 10 years? If you think it will grow, can you please type a 1? If not, can you please type a 0, please? Good. Any more? Any more? I would expect more. Thank you. Any more? So the rest didn't give answer means you all disagree. If you disagree, type a 0. Okay, very good. So everybody thinks that the China technology company is going to grow, right? And no doubt about it. You know, in the next 10 years, they are going to be a bigger company, better company, and things like that. Now, the question here is that, can we all invest in China? Can you all, yes, type of 1, no, type of 0. Directly, can you all invest in the market itself? Can you buy China stocks? No? Never. Okay, if you're not sure, type a 2. If you can buy, can anybody buy into China stocks? If you think you can, type a 1, cannot, type a 0. If you're not sure, type a 2. Okay. Okay, thank you. So for those who type a 2, never mind, it's okay. You cannot invest in China company directly. China does not, well, in theory, I shouldn't be used, I'm not sure if I use the correct word. China's government does not allow foreigner to own China companies. China stock market won't allow foreigner participations, all right? So you can't invest in China by like what we invest in company, you can't. As a foreigner, you can't, right? But we know that the companies, they are expanding, they are growing, you know, and they are going to be as big as the US tech company. In fact, they are already are. You know, you hear companies like Tencent, TikTok, Meituan, and JD. They are really big. No, they are no small fry. They are so big that they are already overtaking some of the US tech companies already. So the question here is that we cannot invest in those companies. And of course, there are more to come now, right? Now, given the, oh, Robert, oh, I didn't know about that. Thanks, Robert. Thanks, Robert. I didn't know about that. Okay. So in order to participate and to grow with the Chinese company, now, first of all, it's also not going to be, you need a bit of China knowledge. You need to know about the technology. And of course, more importantly is that, can you actually get the research material that you want in order to invest in a China company, right? And of course, a lot of us, we still come with a lot of skepticism. It's like, hey, when we invest in the company itself, you know, would that be something wrong or not? Would that something be unsure or not? So we have all these kind of a big hurdles are in front of us, but at the same time, we see that there is a potential growth in the market, the potential, you know, growth of these kind of companies in China and going bigger in the next 10 years. What can we do about it? We can actually go up there and invest in the ETF, right? Now, because the ETF is managed by professional manager, so meaning to say that they have a proper legal systems, proper accounting systems, you know, knowing how to rebalance the, you know, the shares and the company's equity on a regular basis. So you don't have to worry about company to give you rights, give you dividend, or you know, ask you to vote for this and do this and that, or delisting. All this the fund manager will do for you, all right, in the ETF. So that's why it makes our life a lot easier by just go up there and buy a China ETF, and we let the fund manager do all the work and the rebalancing, and we only invest in just one basket of stocks. That's it. Now, tonight, I'm going to share with you one of the ETF you all have probably heard before. Some of you all is the Hang Seng Tech Index ETF. The code is HST.SI. This is an ETF that listed in Singapore Stock Exchange, SGX. Now, with the recent news in China, that the China government, with the antitrust law, and at the same time with the national security laws, there is a lot of fear in the market. And as a result of that, the China tech company has, plunged severely, a lot. And Hang Seng Tech ETF basically are holdings all these tech companies. And because of all these plunge of this price, the valuation of all these companies has now come to what we call undervalue. So for you guys, if you believe in value investing, now is actually a good time to pick up all this company. But of course, there's always a disclaimer, right? Is that that right now the kind of risk that we are investing in China company is what we call the political risk, because of many things that go behind the decisions of foreigners owning Chinese equity or China equity. But if you are value investors, this is a time whereby the institute will sell, retailer will go up there and buy, and that is basically how we invest in this. We look into the details of all these ETF. As you can see in Hang Seng Tech ETF, HSI, you have all the top holdings of this ETF itself. The number one holding is Meituan. Then you have your Alibaba. Sunny Opticals is a company that provide all the lens of iPhone. By the way, I just hear news that iPhone 13 is definitely going to launch in time. So all this company is going to take orders. Tencent, Xiaomi, Kuaishou, which is a streaming, JD, SMIC is a chips companies, Ali Health, and so on and so forth. So you can see that all these companies, they are fundamentally very, very strong company. If you are a finance guy, you open up their annual reports, you will be impressed, with the kind of revenue and the profit margin that they make. But now, because of, policies, there's a lot of fear in the market. So maybe you guys can look into this. Now, this is an example of what we call investing in ETF. Be able to access into a particular market, particular sector, invest in it, take advantage when the price is low, and use this to form one of the portfolio. So rather than focus on individual company and trying to look into the finance, you may just want to look into the ETF itself. So this is basically one of the things. So that is just now what I show you is an example. It's only an example, right? It's not that you must buy this, and this is not a recommendation to buy, by the way. It's just to show you how ETF can help us, to access to a certain market or sectors going forward, right? Now, to go up there and look for ETF, high performance ETF, you can actually screen it to SGX website. Right, it's just right in front at home, right? You can actually scan all this, you can actually screen all this good ETF, high performance ETF, from your home computers. And in fact, it's so near to us. It's using the SGX website. So this is something that I would like to thank you all, because, you guys are so great here tonight, and, so willing to spend the hour with, with us on a Friday evening. So this is how I'm going to show you. You can take away with you, and you can actually screen a good ETF using the methodology, right? So this is a short recording that I have done, and I'll just play back and make sure that you all will have it. Okay, just a minute. So you all pay attention, because this is, this is something that you all can take away tonight and learn how to screen a ETF. In this video, I'm going to show you how you use ETF screener from SGX website to help you to pick the ETF that fit your investment criteria. On the SGX website itself, under security, go to price and screener, then ETF screener. You come to this page, says ETF screener, and it has 5 criteria over here based on fund manager, asset class, classifications, geographic, and benchmark. So I'm going to show you an example. Say if you are interested in China, I'll click on China as the geographic, submit it. Here the screener will pick 9 ETF that is China focused. All right. Let's say if I would like to look at the commodity ETF, I'll go to commodities. And you can see that gold is one of the ETF that listed on the SGX website. Now you have a different classifications you can play around. The asset class divided into fixed income, commodities, money market, and equity itself. So let's say another example, if I only interested in equity, and let's say I want to concentrate on Asia Pacific region, select that, click on submit. You'll see that there are actually 2 ETFs that fit into that criteria. All right. So this is how we can select a ETF using the ETF screeners from SGX website. You can pick the best performance ETF using the screener. Over here on the right hand side, there is a tab says top performing ETF by NAV. Underneath there's a performance of selections, right? So you can select anything from 3 months to 5 years. So typically what I'll do is that I will only select 3 years because 3 years is a good gauge to decide how the ETF performance over a period of time. Click submit and it will give me a list of ETF that's listed from the best performance to the worst. By using all this information, it helps me to pick the correct ETF to construct a ETF portfolio. Okay, thank you to myself. So that's my voice. Okay, one of the wealth accumulating systems, like what Emin has just mentioned, is through regular saving. Now, in ETF, you can actually use this, what we call the regular saving concept as well. Typically, you can use one of the 4 platforms, DBS, OCBC, POEMS, or FSM1. They have this feature whereby you can allocate X amount of dollars per month. So let's say $1,000 per month. And you pre-select the type of ETF, or rather the ETF that you want to invest every month, right? So what the platform will do is that they will automatically deduct $1,000 from your bank and then invest in those ETF that you have pre-select on a monthly basis. All right. You can call this a DCA way of doing it, or you can say it a regular saving plan. I would say it is closer to a regular saving plan, and you start to accumulate all these units, this ETF on a regular basis, on a monthly basis, right? And slowly, you basically you can accumulate to a large amount of money. Now you may say that, hey, do I really need to do this? I'm going to show you why the compound effect that this can, the powerful of this RSP it can be. Now, a typical RSP income portfolio will be in the region of about 4 to 5%. When I say income, meaning to say that whereby your dividend, right, is important to you because you need it. You need a regular income for whatever reasons. So such portfolio will basically pays you. Typically, they will pay you in cash once, or rather twice or 3 times a year. all right, two times or three times per year on giving out dividends. So for those who like income or rather dividend, you can use this as an example, whereby I have 50% of the ETF is in equity, in STI ETF, which is in equity, 30% which is on REITs ETF. Then I will put 10% on gold, just to stabilize the whole this portfolio itself. And then I will have bonds at 10%. So typical portfolio like this will give you about 4 to 5%, on a fixed income. If I'm looking for growth, so when I say look for growth, typically you don't get a dividend payout, right? You don't get dividend payout because you're only concentrating on the growth. Then and then for this kind of portfolio, we will probably be aiming in the region between 12 to 20%. Right? This kind of growth, annualized, I'm not talking about the whole period, annualized 12 to 20%. So things like that, it will have 20% on STI ETF, and then 40% on REITs, so that will actually give you some income, while growth as well. Then 20% on technology type of ETF. So it could be electric vehicle, it can be on blockchain, it can be on 5G, things that will grow, something like 50, 60% per year, kind of a team investing. And then another 20% on US market itself, which is the S&P 500. So a portfolio like this is a growth portfolio, and it will give some dividend, right? Because of the REITs component there, you give some dividend, and the long-term plan is to have it grow between 12 to 20% annually, right? And this is through regular saving plans. Now, if I look at the income portfolio with 4% growth, and assuming that every month we allocate only $1,000, all right, to invest in a portfolio as an example I showed earlier on, then over a period of 10 years, you have invested $120,000, but the return you're going to get is 156, right? But on the other hand, let's say if you are putting into a growth portfolio, right, and with proper rebalancing, twice a year, then the kind of compound that we can grow is $316,000. So which is significantly higher than this. So all these are true regular saving plans, and all we need to do is to go up there and make sure that the portfolios are rebalanced, twice or three times a year, making sure that all the weightage are in the right size. Then most of the time, you are just free to do whatever you want. And this is a very powerful tool that can be used into, as one of the, systems that Yimin had just mentioned, the 6 accumulating systems. And this can become one of the very, very strong, components for you to grow your wealth as well. All right.